Bitcoin becoming mainstream is no different than hedge fund type strategies being available in ETFs. I mean, that's about as mainstream as you can get. Crypto in your 401k plan is coming. These are all major tailwinds to crypto assets.
Today, President Trump signed an executive order allowing private equity and cryptocurrencies into retirement plans and 401ks. This could open alternative investments into everyone's portfolios to millions of Americans who were previously locked out of such asset classes. Should, though, the average investor look into alternative investments? We'll find out with our next guest, Shana Sissel, founder and CEO of Banrion Capital Management, known by the media as the Queen of Alternatives. We'll be talking about the booming world of alternative investments, Fed policy, how to allocate your assets and portfolio in today's environment, and sport management in the world of finance. Welcome to the show, Shana. Good to see you. Thank you for being here.
Thank you so much for having me.
Let's start by talking about alternative investments as an asset class before we get into Trump's executive order and what this means for American investors. So how do you define an alternative investment? What constitutes an alternative asset class?
So for me, an alternative asset class is something that's not traditional long-only equity or traditional long-only fixed income. So anything that is going long short, that's using leverage, hedging, options, private placements, real estate, private equity, like the list is very long. The universe is large, so it's a lot easier to define what it isn't. So it's not those two things, it's everything else. But that's not necessarily how the industry sees it. And as we get into the weeds about this executive order, I think it's important to kind of look at some of the things that I think are positive about it and negative about it.
Are there any particular investments within the alternative sphere that investors should be paying special attention to in 2025?
Well, private credit is an area that I think requires a second look. The private credit markets are as large, if not larger, than the traditional public credit markets at this point. The role that they play in capital markets and corporate finance is substantial. Coming out of the great financial crisis, they became an incredibly important way for smaller businesses, non-traditional businesses, to tap into capital that they needed to grow. And as we have a world that it has less public companies and a lot more companies that stay private longer, they've become really important mechanisms for businesses to fund themselves. That said, that's the one place I'd be paying attention to. And then there's other areas that are just interesting. So I think looking at non-correlated alternatives, hedge fund type strategies is something that everyone can and should look at as they are becoming more and more available through traditional 40 Act structures like ETFs, mutual funds, and now with the advent of interval funds as well. And then also I just happen, and you kind of touched on it in the introduction, I happen to be a huge believer in investing in sports. It's something that I find really interesting, and it's something that has been top of mind and top of headlines in the last year since the NFL approved private equity to invest in NFL teams.
I'm going to get to that. So just to clarify, when you mean investing in sports, it's not my friends going down to the pub and betting on their favorite NFL team for the night. That's not what you're saying.
We are not discussing sports betting. No, we're talking about investing traditionally through private equity products into sports-related businesses. So that goes well beyond professional sports teams.
Okay, I see. We'll get into that in just a minute. Do you consider cryptos an alternative asset class right now, or have they become too mainstream?
No, so there's a lot of stuff in alts that's mainstream. Crypto is an alt. It's not long only private. It's not long only public equity. It's not long only public fixed income. So it is an alt, just like gold, just like any metal or any sort of real asset.
Mm-hmm. I see. This year has seen the rise of alts in tandem with the rise of equities and traditional equities products and fixed income. Rates, as you know, have stayed relatively range bound, so we haven't seen a collapse in bonds while stocks have gone up. Is there a particular reason you think that most asset classes, the large ones, have gone up together despite the Fed not unleashing quantitative easing this year. Gold's got up to new highs. Bitcoin's reached new all-time highs. The S&P's reached new all-time highs. Why is that?
Well, I think the uncertainty in the marketplace and the volatility in the marketplace has been supportive of traditional hedging types of assets. So hedge fund type strategies, long short equity, things of that nature. That's also, enhanced fixed income. And you can throw private credit into the fixed income bucket. Private credit's done quite well because traditional banks have not been lending to the same extent that they once did. And then if you think about, there's a lot more IPOs going on. The venture market's starting to heat up again as there's more and more opportunity out there. So there's that aspect. But I would say that it's not necessarily all very correlated. In fact, one of the best parts about alternatives is that it's such a vast universe. It's really hard to just throw it all in one bucket and say, sure, yeah, also doing really well. You could argue private credit and private equity have done really well, and perhaps some long short, but I would argue that there's definitely large segments, managed futures, global macro in particular, that maybe haven't done as well, but I wouldn't expect them to either. Those are low to no correlation asset classes that I would expect to do well when the market doesn't. But those asset classes actually did really well in the beginning of the year because the market, was in a tailspin.
Well, let's move on to talk about the news item of the day. Trump's executive order allowing private equity, real estate, cryptos, and other alternative assets in 401k retirement accounts. So immediately following this announcement, Shana, how do you see 401ks changing into the next couple of years?
I don't know that they change much. I think that this executive order is missing a lot of clarity that's going to be necessary before plan sponsors would ever start to implement this type of approach. There's a laundry list of things that need to be considered, not the least of which is, how exactly do you invest in private equity if you're talking private placement in a 401k plan? They have subscription documents. There is a know your customer. There's suitability guidelines. These are not, traditional 40 Act, so they're not available to everyone. So figuring out what that looks like from legal and compliance standpoint and how they make these things available matters. The fee structures matter. All of those things are something worthy of consideration. Liquidity issues, all of those things would need to be addressed. So I don't think any of that stuff is coming to your 401k plan anytime soon. I think it opens the door for the discussion, but I think we've kind of jumped over what could have been the most logical way to start this process of alts in your 401k plan. Is there a reason we don't have ETFs as a commonly used option in 401k plans? Because they're not. Interval funds in a 401k plan makes more sense to me than this. These are all things that could actually be executed more easily. They don't have some of the know your customer subscription onboarding issues, compliance, legal issues that a plan sponsor would have the risk of. And after the Department of Labor rule changes and guidance from 16, 17, 18 that caused fee compression, and a lot of plan sponsors removed financial advisor guided 401k options because of the fees that were involved. This is completely counter to the trend of lower fees, making everything cheap in your 401k plan. So there's all kinds of questions. There's more questions here than answers that I think is going to be preventing these things from becoming commonplace anytime soon.
But just in principle, do we need this? I mean, this article from Reuters, for example, this sentence says, proponents argue that younger savers can benefit from potentially higher returns on riskier investments in funds that get more conservative as they approach retirement. Does that make sense to you? What's your response to that?
There's ETFs and mutual funds and interval funds that can absolutely provide that. Most 401k plans go with index funds for a reason, because you only choose 10, and that's typically your options because of the risk to the plan sponsor. It has nothing to, there's no reason you couldn't just do self-directed brokerage and allow younger individuals to buy, a Bitcoin, like a BitB in their 401k. But there's a reason that not a lot of 401k plans have self-directed brokerage. There's a cost associated with it. There's an additional layer of compliance. I don't buy that argument for a variety of reasons, not the least of which is those younger savers are the least likely to be qualified for these products.
Well, should the average investor that's not institutional be exposed to private placement deals, or not just private placements, but private investments in general, like the hedge fund products you talked about, like the private equity products you talked about? What benefits do we have as individuals?
I absolutely think the democratization of alternatives is a positive thing. And actually, one of the things that kind of sparked my interest and made me so passionate about it was that I was working for a hedge fund during the financial crisis, and I had funds blow up, but I also had funds outperform. And I remember thinking to myself, I wish my dad could invest in something like this, but there's no way for him to do it. I wish I could invest in something like this, but there was no way really for me to do it. That was just when, mutual funds that were hedge fund-ish started coming to the marketplace, the 1-20-20, 1-30-30 kind of thing. But I absolutely think that they should be available to most, within reason. Not everybody needs to have everything. There are certainly different structures and wrappers of which these products, and again, I can't emphasize this enough, this is a vast universe. I can argue that equity market neutral, long short, option-based types of products that are hedge fund-esque absolutely should be accessible to everybody. And they largely are in mutual funds and ETFs. Okay. But things like private equity, private credit, of those natures, the illiquid stuff, the things that don't have daily pricing, that have suitability guidelines, those things maybe aren't for everybody, because maybe not everybody wants to lock up 10 years worth of their money and have absolutely no way to get out of it. Maybe there's all kinds of other reasons. These are sophisticated products and they have accredited investor and qualified purchaser hurdles for a reason.
So like you said, it's not for everybody, and a lot of it is very sophisticated. It's a very large universe of products. Where do we get started then if we want to dabble into this space? I
always say the best place to start is with the liquid things. So there are hundreds, if not thousands, of mutual funds and ETFs that do hedge fund-like strategies. So I'll pick on some that I just happen to be quite familiar with because they're partners of my firm. But, we work with AGF Investments, which is a large Canadian asset manager with a US base. They have an ETF called BTAL, which is a hedge fund-like strategy. It's an equity market neutral, long short. It goes long, low beta, short, high beta. CBLS, Clow Capital, is a hedge fund firm founded by Chuck Clow, formerly of Merrill Lynch. He has a bunch of hedge funds, but he also has an ETF, CBLS. You have AQR has Global Macro. They have a macro allocation fund that's phenomenal. There's plenty of things in that space. Once you're comfortable with how these things work in your portfolio, because they really do need to be built into your portfolio differently. And I don't think we do a great job helping people learn how to build portfolios of alternative strategies. Then you can start looking at, say, an interval fund. Interval funds are available to most investors, and they are illiquid, quarterly redemption kind of products. So a good way to get used to illiquidity, but with smaller minimums, and you can get exposure to, private credit, private equity, venture capital, private real estate through interval funds. There's about 300 on the market today. And then maybe once you've gotten some comfort with A, alternatives, B, illiquidity, then looking at, the larger, more vast universe of private products and private placements would be kind of how I would guide people to as they dip their toe into the space.
Would you have an insight as to what the ideal allocation should be? Not 60-40, obviously, because we're now allocating more space to alts. I mean, what percentage of a portfolio should be alts? So
I generally think 20% is sort of the optimized amount. Anything less It doesn't really have the positive impact on your portfolio. Anything more, it can, detract from the alpha that you can get from equities. But I also like to point out that there's two different types of alts. There's the diversifying alts, which are your hedge fund-like strategies, real estate, crypto, real assets, things of that nature. And then there's the non-diversifying, which is just equity and credit in private form. And those actually belong in your equity and credit allocations, not in your alternative allocation. And that is a hill I will die on, because while they may not price daily, so they may look less volatile or look like they don't have the same correlations to equities, they very much do. And so, you should think of them as an illiquid component of your equity and fixed income. But an actual dedicated diversifying alt sleeve at 20% sort of the optimal mix, where it actually improves overall portfolio returns. Nothing that's going to blow your socks off. I just always like to lead with that. Maybe 20, 30 basis points annualized, but it will substantially reduce the volatility of the portfolio. And, financial advisors, I'd like to always tell them, the portfolio your client should be in is the one they can stick with. And typically clients are more likely to stick in portfolios that aren't particularly volatile, but still helps them get to their goals. And alts are an excellent tool to do that.
So on the equity components, the private equity, like you talked about, that's more of like a longer duration, or perhaps like a higher beta play on public equities. Is that kind of the play here?
In theory, they should be a higher alpha play in equities.
I see.
In theory. They haven't necessarily done that in recent years, and there's a whole bunch of reasons behind it. But in theory, there should be a premium that you get in your return because they're illiquid, and that should be sort of an alpha opportunity in your equity. And same thing with private credit. It should be an alpha opportunity in your fixed income.
How have they performed this year relative to public equities, which, like I said, have broken new highs?
We only have 2 data points really to work with here. But they've generally performed in line with traditional equities. They do look better in the first quarter because it was a volatile quarter where February was particularly bad, but they typically price in March. And so they're able to take advantage of a bounce back, and they don't have to show the declines that they saw in February, which the market would. But overall, they've been correlated with your traditional equity markets. Private credit has done quite well, better than traditional fixed income. So they've done amazingly well. And then on the hedge fund side, when you start to look at, say, your diversifying alts, obviously you touched on it, like crypto has done amazingly well, though it's been quite volatile. You're seeing a lot of really strong returns from middle market direct lending and things like real estate debt on the private side. And venture capital was struggling, and you weren't seeing the kind of returns you would expect from that asset class earlier this year. But the market is starting to get a lot hotter, and you're starting to see venture capital funds start to allocate and actually put money to work. One of the reasons why VC had struggled earlier in the year is because a lot of VC funds weren't actually investing in anything. So they were holding cash, or they hadn't called capital.
What indicators would you look at from a macro perspective that may, show you whether or not to allocate more into diversifiers or into equities?
So I really think that the 20% into the diversifying alts is like a permanent thing. I think where you come into your how do I want to be tactical is on the equity fixed income side. And I would generally look at correlations between fixed income and equity. So when correlations between fixed income and equity are high, you actually want to allocate more to equity and keep that alts bucket at 20%. And so anything you put into alts would come from fixed income, not equity. And that tends to be the periods of time where equity and fixed income are highly correlated is typically when alternatives actually shine.
It's interesting how you aren't classifying fixed income as a diversifier in itself. Is that something that you don't, perceive? Is that not the role here anymore?
Well, it is a diversifier, but if you look back in recent years, you'll see that fixed income performance has been highly correlated to equities. And it really, when it comes down to it, when you're building a portfolio, it's all about having diversification. I think it was Michael Kitchis might have said it, but like diversification means always having to say you're sorry. If everything in your portfolio is working at the same time, you're not diversified.
Yeah,
And
fair
so
enough.
your focus needs to be on having like true diversifiers. So fixed income and equity are both doing amazingly well at the same time. It's probably not providing you the diversification that you need. And we've seen periods in the last couple of years where fixed income and equities have actually done poorly at the same time. So alts have really shown during that period of time. Things like managed futures, global macro, market neutral strategies, even some option overlay strategies can actually provide a lot of diversification benefits. Crypto is incredibly diversifying. I know people don't like to hear that. In very small doses, you can actually get a lot from your crypto allocation, even with the volatility. Real assets, agriculture, you start talking coffee and, all things of that nature are incredibly diversifying. So those things belong in your alt bucket. And that 20%, I think, should be stable. Now, we could discuss how you might change the tactical allocations within your alts bucket, but that 20% to me is kind of a stable 20%.
I see. And what is your reaction to Bitcoin becoming more mainstream in treasury holdings? There are now many companies rising as treasury holding companies, with their primary objective being to buy and hold Bitcoin. How does this change? How does this trend change the alt narrative?
I don't know that it necessarily does. I mean, Bitcoin becoming mainstream is no different than hedge fund type strategies being available in ETFs. I mean, that's about as mainstream as you can get. The value proposition and what they bring to the table hasn't changed. It's still very limited supply. There's still technical tailwinds to Bitcoin and Ethereum in particular that aren't going away anytime soon, that are incredibly favorable for long-term investors, as it's still not, I know we talk about it all the time, it's still not largely adopted by the vast majority of investors. And access to these Bitcoin ETFs has made, the demand for Bitcoin grow at a time when, supply is limited, very limited. It's actually only a certain amount. That's never changing. And with the halvings that happen every 4 years, things of that nature, those are all technical tailwinds. And with greater adoption, the vast majority of wealth managers out there haven't actually approved their advisors to allocate to crypto. And that wave is maybe in the first inning. So that's coming. Crypto in your 401k plan is coming. These are all major tailwinds to crypto assets. I think we need to be concerned, though, because crypto is a place where there's a lot of bad actors and a lot of fake stuff that comes up that people get excited about. So when we talk about crypto, I always like to say that your focus should be on the crypto that have a blockchain with a use case. If it's a crypto asset that's not attached to a blockchain and has no use case, it's just a meme, then it's probably not something you should be looking at.
Well, just one question on that. That's a very good point that you brought up. It's not up to the individual investor to pick what's in their 401k if they actually subscribe to a plan. The fund manager behind the 401k selects which cryptos ultimately would be going into this retirement plan. And so what guardrails or criteria should be in place such that the fund manager doesn't select something that is scammy in nature or, like you said, non-legitimate?
All right, so a couple of things worth noting. 401k plan sponsors and firms like Fidelity and large organizations that do corporate 401k administration, the administrators, are the ones who dictate what goes in 401k plans. That's why you see nothing really interesting in your average 401k plan, and it doesn't matter how robust it is. You typically see index funds. On purpose, because it's a risk and there's a fiduciary responsibility, there's an educational component, and most plan sponsors have to be worried about the risk of compliance, legal and educational requirements of bringing complex instruments into the 401k plan. It's also going to be limited to things that can be put in a commingled structure and that have scalability. So there's almost no chance you're going to see anything other than Bitcoin and ETH.
Okay. So due to, I guess, not just regulatory reasons, but compliance reasons for existing funds and managers. I understand. Well, that leads to sports management. It's a specialized area that I suppose you need some expertise in to be able to invest properly, which I guess falls into the category of alts that require specialized knowledge. And well, tell us about that space and why you're looking at that as an investment vehicle, not just as a matter of personal interest.
Yeah. So, and for background, I started my career, graduated from college with a sport management degree, actually worked in professional sports for a time, and am just a major sports fan in general. I've been in the same fantasy football league with a bunch of other people in finance for like 5 years now. But I happen to just love sports. And I think the average American also happens to love sports, as we can see from the the ratings that we get for the NFL and for major professional sports. And also, if you look at the streaming networks, some of their most popular programming is around sports, whether it be popular sports or things like, F1, golf, things of that nature. The point being is that the number one thing that drives valuations in sports, whether it be for professional teams or leagues and things of that nature, is media rights. And we now live in a world, and I'm sure people saw the Disney announcement yesterday with the NFL. We now live in a world where there's a lot of people competing. When there used to be, 3 networks, maybe 4, that were competing for media rights, we now have not just multiple networks, including Netflix, Amazon Prime, Apple TV, Disney Plus, competing for the media rights. But it's become incredibly important because all of the media outlets, and it doesn't matter which, make their money off advertising. And the only thing that really can garner a premium for advertising is live events. And the only live events where people really want to watch live is sports. And there's enough variety of there where you're seeing bidding for media rights on types of sports that never really got a lot of attention going through the roof, because the live programming is the lifeblood for any content provider. Because advertising is the lifeblood of their revenue.
Okay, so let's take the story that you referenced, for example. NFL's taking a 10% stake in Disney's ESPN. How does that translate into an investment case?
All right, so from an investment case, Disney and the NFL becoming involved, now that helps Disney, because now Disney has that live sports component. They always had it with ESPN, but ESPN was kind of one of the areas of their portfolio that wasn't necessarily providing as much revenue to their bottom line as other areas. And they were looking for ways to better monetize it. So having the NFL involved allows them to monetize things like the red zone, and also bring in new subscribers to Disney Plus. That's a huge win for them. Disney Plus, I don't know about the audience here, but I have a subscription to Disney Plus simply because I have a child, but I couldn't tell you the last time I tried to watch anything on Disney Plus, because the actual content there, the programming, is not the kind of content that people, are barely excited to pay a subscription fee for. So when you look at your stack of all the streaming services you have, Disney Plus is one of the ones on, the bottom that you would, cut back on if you were looking to cut back on your spending on streaming. So they need to be able to compete with, say, Amazon Prime, which has NFL. Apple TV has Major League Baseball. Netflix has been able to get NFL rights. So all of these things, I think, really help in terms of, if you think of Disney as investing in sports, they're doubling down on this, and the NFL needs Disney as well for a lot of reasons. But having this broader reach is important. And as an investor, when we talk about investing in sports, the headline is owning a professional sports team, and that is an ego-based investment. That absolutely has attractive valuations, but where you really can make your money is in the areas that are underappreciated, like name, image, and likeness as it relates to the NCAA, women's sports, Caitlin Clark effect. We're seeing investments in things like F1, where they're becoming, more and more visible, and they're doing more events, and they're more involved in streaming, creating content around sports that will engage your subscribers and engage advertisers. These are the way that you invest in sports. It's not about having a minority interest in, the Boston Celtics. That's cool, but you're not going to make the vast majority of your returns off that, but you will on the new women's WNBA team that they're looking to put in Boston. That is more likely to be, a rocket ship investment, because the actual valuations on those things are so low, but the demand for the media rights is so high.
Are there any instruments that allow me to be directly exposed to the valuation of a sports team besides maybe NFTs?
It's just private equity. So there's firms like Avenue Capital is the one that stands out to me. Avenue Capital, obviously founded by Mark Lazary, who used to own the Bucks. They have a sports rights fund. There's Kaz Investments has a feeder fund to a larger, I can't remember the name of the firm. It starts with an A, firm that also does sports investing. Blackstone is putting together a fund, but they're all private equity oriented. I have heard rumors that there will be at least one sports investing related interval fund coming to market. So keep an eye out for that. That will be an easy way for the vast majority of investors to gain access. But those are the key ways to do it. I wouldn't even consider NFT to be, the best and most attractive way to invest in sports. You want to do it to some sort of commingled product where you have a portfolio manager who's making actual decisions on what deals to be involved in.
Have you looked into the esports segment? Supposedly video games bring in more revenue than movies and music combined. So I'm curious as to whether or not this space has a future.
Oh, I have. My wallet is attached to Fortnite because my son is a massive Fortnite fan, and he actually schedules his life around live tournaments. And I was talking to somebody.
How old is your son, just for context?
He's 10. He's already planning, and he keeps asking me if he can go to like the International Grand Championship of Fortnite, which last year it was somewhere in Europe. He's super into it. And, I recently heard, I was on the East Coast on vacation, and somebody mentioned that Salve Regina's only major sport is esports. And while, we don't know their names, they're not getting major endorsement deals. The way that gaming is becoming popular, and the way that these big tournaments are happening, and the purses that are given out is meaningful, and it's relatable. And so there's this entire generation that's coming up on like live Fortnites, all sorts of different games out there, and gaming absolutely is a major place. And it's just a matter of time until you start seeing content created around gamers. YouTube's already doing it. My son spends 90% of his day watching YouTube videos of other people playing video games. And I guarantee you, if there's other parents in the audience, they will agree that this is what kids watch these days, and they all want to be doing that, but they're all watching YouTubers. And
so how do we capitalize on this trend? I mean, buying buying Activision stock, for example, maybe one way to do it. Anything else?
I think the major way to do it is, I think we have to start thinking about how the next iteration is. Like I said, if kids are watching YouTube, it's just a matter of time before Netflix and Amazon Prime come up with some way to create content around it of which they can charge for. And then you become, again, like traditional sports, a media rights issue. It's just a matter of time. Now, it's not the most exciting thing in the world to watch live. It's not like live sports in that sense, just the nature of how these things are done. But I do think it's just a matter of time before we start to see more content coming out from the streaming networks and the like that can be monetized.
Okay. Finally, I want to end on actually your experiences working in the asset management industry. You've been in the space for decades. You've worked at a lot of big firms, including Fidelity. I wonder how the space has changed in the way that they've selected investments, in the way that they've built portfolios, in the way that they've prioritized certain assets over others over the last 2 to 3 decades.
So I think the biggest shift you're starting to see is in the alt space. I think everybody and their mother's trying to find a way that they can kind of dip their toe. It's the one place that the traditional retail investor in the retail market where there's trillions of dollars to be had hasn't allocated. So the opportunity to take market share and to put product out there is massive. And we're seeing things like the executive order from the White House and crypto becoming more mainstream. These things are just pushing that trend out there. We're also seeing, and I think this is broadly underappreciated, the growing parts of asset managers that are doing open architecture types of investing. I worked for Fidelity Strategic Advisors, which started doing exactly that in 1999, understanding that like the better way to go would be to do open architecture type of products where they don't have just their proprietary product. More and more you're seeing firms do that, and partnerships across firms, Apollo and State Street, things of that nature, Bridgewater and iShares. These things are a result of, asset managers seeing that there's an opportunity out there where partnership makes more sense. And this idea of, with the focus on fee compression, the focus on indexing, in order to be able to have a premium fee and to generate revenue through asset management, you really need to have a product that can compete and be differentiated. And that's where we're seeing a lot of opportunity today. And that's where I think the industry is going. Excellent.
Let's finish off by talking about your work right now and Banrion Capital. Let's talk about, tell us a little bit about what you do and some of the products that you people can expect to find.
Sure. So Banrion is actually a technology platform. My background is in asset management and building alternative portfolios, but it was because of that experience that I noticed that there was a massive hole in the market for the wealth management channel in terms of being able to allocate to alts in a meaningful way. Obviously, as I've noted, that's a trend, and I think that's not going away. There's certainly demand. The reason I think it's been slow in terms of adoption has been that the operational compliance and just back office workflow framework is incredibly archaic and so far away from being able to support the advisor's business. It's been all about distribution and access, and none of it's really been about helping the financial advisor do it in a way that doesn't make their practice exceedingly more complicated, where they have to spend tons more money and add a million different things to their tech stack. So Banrion was really built with the idea of having an advisor-centric technology solution that is also a marketplace of idea flow, where they can have, access to interval funds and ETFs and mutual funds in the space, and not just all about private product. I think that that's really important, because that's where you see initial adoption into the space, as we touched on early in this discussion. I think that you need to have solutions that people can use as they become more and more comfortable with the space. And then once they do get to the more complex stuff, I touched on this, like the subscription documents, the onboarding, the oversight, the compliance, all of that becomes substantially more complicated. And the average advisor does not want to hire 4 new operational people in order to do it for them, and then add 4 new software programs to their tech stack to kind of piece together what they need. So Banrion was founded with the express purpose of solving all of those problems for the advisor. So that's really what we do, is help advisors allocate a scalable way for all of their clients to alts, and help them begin their journey in alts as not just a way to diversify client portfolios, but also to help them differentiate themselves and provide something different and personalized to their client base in terms of helping them also grow their businesses.
So actually, your platform is kind of like a proxy for alts interest, and you can kind of gauge what people are looking at and what's interesting and trending right now, depending on their searches. I mean, any hot topics or trends that are coming up recently?
The number one thing that we're seeing have the most success right now is in real estate funds. Real estate is so not sexy, and it's not something particularly exciting, but the income producing aspects of real estate and just being able to have that type of investment as a consistent form of income, especially in retirement, is incredibly appealing. So real estate, private real estate has done quite well. Some of our best partners are in that space. And then the other areas are private credit. Again, nothing that is going to knock your socks off or feel like this is new and interesting. We did a survey about a year ago. I was absolutely convinced that every advisor was going to want sports rights. Every advisor was going to want sports investing. But the survey actually showed that the vast majority of advisors were interested in private credit and real estate.
Wow, it's interesting. I wonder if that's because people are expecting rates to come down. But
I'm sure there's a variety of reasons, but I ultimately believe it has to do with consistency of income in client portfolios and being able to generate income in a way that they're just not with rates. We can talk about rates being higher, but ultimately, in a historical sense, rates are still pretty low. So You're not generating a ton of income from traditional fixed income. So people are looking for other ways to sort of compensate for that. And that's where yield, alternatives are great yield alternatives.
Let's talk about passive income and yield generating alts next time. Great talk. Thank you very much, Shana. Where can we learn more from you in the meantime?
You can go to our website, which is banrioncapital.com. Find me on X, Shana S621, LinkedIn. I'm on Instagram. Easy to find. I'm everywhere.
Yes, you are. All right. Great social media links. So check them out. Links down below. Shana, good to see you and good to meet you. We'll talk again soon. Take care for now.
Thank you.
Thank you for watching. Don't forget to like and subscribe.